We have Rahul Vuskute now joining us to talk more about markets. Rahul, good afternoon. Thank you so much for your time. Uh, you guys at Bharti AXA Life, what are you making of the broader market resilience which has come back? That entire negativity triggered by some commentary from AMFI on stress test of the mutual fund small and mid cap, plus of course regulator comments on froth in that pocket. All of that appears to be getting digested. You think valuations are comfortable now to get in?
Yeah, so good afternoon to you, Ajay, and to your viewers. Very happy to be here. I think, yes, you spoke about market resilience, and that's really been the heartening feature of this market. One could make the argument that valuations are higher on a historical basis or compared to other emerging markets, etc. But the market has shown resilience wherever there have been dips. The market has been bought into, sectors have been bought into, stocks have been bought into. And I think if you look at it from another perspective, look at India VIX, that's come off significantly. A handle of 10 is something which is very, very comfortable. You spoke about some local events, regulatory events. I'll also add some global events to that. In the last 3-4 months, you have DXY, the dollar index, that has gone up from a sub 100 to 105, 106 level. You have crude, which has risen from 70, $75 to touching 90. I'm talking about the Brent here. You've had US Fed rate cuts where the consensus was 4 to 5. It's now 2, and there's also a narrative around whether even 2 will happen. There's geopolitical risk with countries lobbying funny things at each other. And yet our markets have continued to show resilience. And as I said, that's really been the heartening feature for an existing investor in the market, and for investors who are yet to enter into the market in a meaningful way. This should provide more confidence.
Over the last few weeks, from a complete 400 plus kind of a estimate of NDA, the market's estimates seem to have come down. As long as the current leadership continues, is that okay? Or the quality of the win, a weaker win versus strong win, would that impact the market sentiment in near term in your view?
Sure. So I think what markets look for, Ajay, is stability, continuity. And when I say continuity, this is continuity of politics, continuity of policy, continuity of the economic decisions that are being made. Now, in that context, the market positioning was and continues to be for a continuation of the current dispensation and policy continuity subsequent to that. Now, if for some reason that gets disturbed, then definitely market will have a little bit of shock, and you might see market coming off a bit. Otherwise, as long as that broad policy continuity and political stability narrative remains, I think the market will look past that. In any case, this is for the shorter term, right? I mean, after 6 months or so, we'll all be looking at the same things that we've been looking at. What's the volume growth? What's the earning growth? What's the quality of earnings? That's going to be driving the market after 6 months or so. So I think the markets, especially given the current resilience we are seeing in the market, the flows that we are seeing, I would expect that even if there is an event, it will be short-lived, and beyond that, it will all be driven by the core earnings.
Right. Just a quick view on the quality of overall earnings growth which are coming so far. What are your thoughts there? There's a pocket which believe that because of higher base, the speed of growth will actually slow down in the coming quarters. Others believe that as long as portfolio level earnings growth is in 15, 18, 20% range, valuations, there's a support out there. What are your thoughts on observations so far?
Sure. So let me just give a quick commentary on what we expect in terms of Q4 earnings. I think we are kind of quite close to estimate there of about 8 to 9% index earnings. We do believe that sectors like financials, auto, pharma, and healthcare should be driving those earnings. Perhaps IT, FMCG could be a bit of laggards, but will still be within expected lines. Outside index, we expect sectors like industrials, real estate, power to contribute meaningfully to the earnings outcome and the earnings narrative that we have been seeing. We've been seeing a really strong earnings narrative in this financial year. Going forward, definitely there'll be a base effect that will pose a bit of a headwind. Second, I think the margins, this the earnings outcome for this year has been driven by juicing up of margins. That is likely unlikely to continue next year, especially as the commodity prices, the raw material prices have started rising. And therefore, I would think that volume growth will need to do all the heavy lifting in the coming year. In terms of sectors, clearly the top three sectors might be under a bit of a challenge. Uh, uh, IT, because of the uncertainty in the US and elsewhere, and that is persisting. FMCG needs, in a sense, a rural economy revival, rural demand revival, and even BFSI, which was reporting very strong earnings growth, might moderate a bit because of discussions about LDR and some of the regulatory actions that have been taken recently. So I would expect the earnings to be a bit more challenging next year. That narrative as compared to this year. Um, if we look beyond that, if I look at the current market levels on the expected FY26 earnings, the consensus earnings, that's at 18.3, price to earnings of 18.3. Is it cheap? No. Is it very expensive? We have seen levels of 20 and 22. So I think markets broadly should be comfortable with with what we are likely to see next year. Positive surprises can come from IT and FMCG. If, as I
That's a
said,
very nice contra view, Rahul, that you're making. IT and FMCG could surprise positively. Thanks very much for your time. We'll keep an eye out for these sectors. But
If you like this video, then like, share and subscribe to ET Now.